Hey everyone, welcome to another deep dive. We've got quite the stack of sources to get through today.
Yeah, some interesting stuff this time around, kind of all over the place, business financed, even a little bit of tech history.
And it's wild how it all kind of comes together. I
Yeah.
think it really paints a picture of where things could be headed, both for investors and anyone just interested in the impact of tech on our lives.
Definitely a lot to unpack here.
So you ready to dive in?
Always.
All right. Well, Jim Cramer's been sounding the alarm lately on some major underperformance, in those classic dependable sectors,
Mm.
consumer products and healthcare.
Yeah, and what's really interesting is that these companies, those big names like Procter and Gamble, General Mills, they're wrestling with these rising material costs.
So it's squeezing their profits, basically.
Exactly, and that's why we're seeing those stock prices take a hit. And Kramer, well, he doesn't mince words. He's calling some of these big names value traps.
Value traps, meaning even though they look cheap, they might not be a good investment.
Right, that's the warning, basically saying, their struggles might not be temporary. They could be stuck in a rut for a while.
So what does that mean for someone like me, interested in investing, but not exactly a Wall Street expert?
Well, it all depends on your investment style, and your risk tolerance.
Mm.
If you're looking for those quick gains, these might not be the best bets right now. But if you're a long-term investor, there might be an opportunity there.
So maybe these dips are buying opportunities, but only if you're in it for the long haul.
That's the key takeaway. Now, on the other hand, you've got companies absolutely crushing it, like those retail giants, Costco, Walmart, Amazon. Kramer calls them inflation fighters.
Because they're pushing back against those rising prices, right?
Exactly. They've got the power to negotiate those better deals from suppliers, and they're passing the savings on to us consumers.
That's good news for shoppers, for sure.
Yeah.
But what does it mean for the market overall?
It could signal a shift in power. These inflation fighters, they're putting pressure on those struggling companies to adapt or risk falling even further behind.
So it's like survival of the fittest playing out in the stock market.
You could say that. And speaking of companies riding the wave of success, we got to talk about NVIDIA.
Oh, yeah, they are on fire right now.
Yeah.
All thanks to that insane demand for AI chips.
It's been a remarkable year for them, but one analyst we've got in the stack here is urging caution.
Oh, why is that? Everyone's suddenly worried about the AI robots becoming self-aware.
Haha, not quite. The concern here is more about NVIDIA's reliance on a few really massive customers, like Microsoft, for example.
So what happens if those big spenders suddenly decide to cut back on their AI investments?
That's the million-dollar question, right? NVIDIA's growth has been explosive, but is it sustainable? If those big tech companies tighten their belts, the ripple effect could be huge, not just for NVIDIA, but for the entire tech sector.
And that kind of brings us back to Kramer's point about the inflation fighters. They're the ones fueling AI development, right?
Mhm.
If their budgets shrink, the whole AI ecosystem could take a hit.
It's a domino effect, and this really highlights how interconnected everything is in the market. One seemingly isolated event can trigger this whole chain reaction.
Okay, that's a little scary, but also fascinating. It's like we're all trying to figure out how to survive in this giant, complex ecosystem.
Great analogy. And speaking of forces that can shake up the entire system, let's zoom out to the broader economic landscape. The strong U.S. dollar right now, it's a hot topic.
What's driving that?
Well, there are a few factors in play. One is the difference in interest rates between the U.S. and Europe, but the real wild card here is the uncertainty around President-elect Trump's policies.
It seems like politics is always throwing a wrench into the economic gears.
Definitely adds another layer of complexity. The source we're looking at here suggests that if Trump's trade policies end up hindering global growth, we might actually see a weaker dollar.
Really? I thought a strong dollar was always a good thing.
It depends on your perspective. A weaker dollar can actually benefit companies that export goods because their products become more competitive overseas.
Oh, that makes sense. So it's not as simple as saying a strong dollar is good or bad. It all depends on the context.
Exactly. This is a perfect example of why investing isn't just about crunching numbers. You have to understand the global forces at play and how they can impact different parts of the market.
So it's like this giant chess game, but with real-world consequences.
You could say that. Now, speaking of political shakeups, there's been a pretty surprising development at the Federal Reserve.
You're talking about Michael Barr stepping down.
Right. The head of banking supervision is resigning, and it seems like it's to avoid a potential clash with the incoming Trump administration.
That's interesting. So now Trump gets to appoint someone new from within the existing Fed board.
Yes, and that's what has a lot of people wondering, what direction will this new appointee take? Will they maintain the current level of oversight, or will they take a more hands-off approach to the banking industry?
If they go the hands-off route, wouldn't that mean more freedom for banks to take risks?
Potentially, yes. And that's what has some people worried. Less oversight could lead to more instability in the financial system.
So this is definitely something to keep an eye on. It could have major implications down the road.
Absolutely. Now let's shift gears from the world of high finance to something a little more down to earth. Have you heard about New York City's congestion pricing plan?
Yeah, isn't that where drivers have to pay a toll to enter certain parts of Manhattan?
That's right. It just went into effect, and it's basically a giant real-world experiment in behavioral economics.
How so?
Well, the goal is to reduce traffic and raise money for public transit improvements. But will it actually work?
Yeah.
Will people change their commuting habits and opt for public transportation?
Or will they just grumble about it and pay the toll anyway?
Exactly. And if they do just pay the toll, will it actually solve the congestion problem, or will it just create a new revenue stream for the city?
A fascinating question. And
Yeah.
it'll be interesting to see what lessons other cities can learn from New York's experience.
Absolutely. Now let's talk about real estate. One of our sources paints a surprisingly optimistic picture for real estate investing in 2025, even with challenges like low affordability and limited deals available.
That's interesting. I know a lot of people are feeling priced out of the market right now.
Right. But this source argues that long-term investors can still achieve financial independence within 10 to 15 years, even using what they call vanilla strategies like buying rental properties.
So you don't have to be a real estate mogul flipping mansions to make money.
Not necessarily. This source emphasizes the importance of patience and a well-defined strategy. They're basically saying that if you're in it for the long haul, real estate can still be a solid investment.
But what about all the talk about a potential housing bubble? Doesn't that make things riskier?
Well, one of our sources takes a look at the S&P 500's KP ratio, which is a metric often used to gauge market valuations.
And what does it say about the current state of the market? Are we on the verge of another dot-com style crash?
Not necessarily. While the KP ratio is elevated compared to historical averages, it's nowhere near the levels seen during the dot-com bubble of the early 2000s.
So it's not a screaming red flag, but it's still something to be aware of.
Exactly. It's important to understand the context. While valuations might seem high, factors like low interest rates and strong corporate earnings could justify them.
So we should be cautious, but not panicking.
Right. And this brings us to another interesting prediction, a potential broadening equity market performance in 2025. This means that opportunities could lie beyond the mega-cap tech giants like Apple and Microsoft.
So instead of putting all our money in the usual suspects, we should be looking for hidden gems in other sectors.
Exactly.
Yeah.
The source even points to companies like Qualcomm and Cisco as potential beneficiaries of economic growth and stable inflation.
It's all about spreading the risk and looking beyond the obvious choices.
Precisely. And finally, let's step back in time for a bit of a history lesson. We have this incredible conversation with Yahoo co-founder Jerry Yang, reflecting on the company's 30-year journey.
I'm really curious to hear his thoughts on the evolution of the internet. He's seen it all from the early days of dial-up to the rise of social media and now the AI explosion.
He's got a front row seat to history, and he's not afraid to share his insights, both the good and the bad. In part 2, we'll dive deeper into what he has to say about the dot-com bubble, the importance of company culture, and of course, the current AI craze.
Can't wait.
Yeah.
This is getting really good.
Yeah,
I think we need a quick break before we jump into part 2. I need to process all this information.
I hear you. Let's take a pause and come back refreshed and ready to delve even deeper.
All right, we're back. And ready to dive even deeper into all of this, market trends, economic forces, and tech history. We left off talking about Yahoo co-founder Jerry Yang, right? His 30-year journey in tech. And what really struck me was just how candid he is about, both the successes and the missteps along the way.
Yeah, he doesn't shy away from those tough questions, does he? Which makes his insights even more valuable, He's seen it all firsthand, the highs and lows of the tech industry, from that dot-com boom and bust to the rise of mobile and social media, and now this whole AI explosion.
It's like having a personal guide through the evolution of the internet.
Exactly. And what I find really fascinating is how he connects the dots between those past experiences and what's happening now with AI.
He sees parallels.
Definitely. He talks about how the dot-com bubble was fueled by hype and this lack of understanding about the internet's true potential.
He even admits that Yahoo's valuation at the time was, inflated, driven more by market excitement than the actual fundamentals.
Yeah, he's refreshingly honest about that. But he also points out that AI is different. It's not just about building websites or chasing clicks, it's about transforming how we work, live, interact with the world.
So the impact is more tangible, more real.
Exactly. And he emphasizes the crucial role of data in this AI revolution. He believes that companies with unique and valuable data sets are going to have a huge advantage.
So it's not just about having a ton of data. It's about having the right data.
That's the key. And it reminds me of something we talked about earlier. NVIDIA's reliance on those big tech companies for their growth. What if those companies start to prioritize ethical considerations in their AI development? What if they decide to be more selective about the data they use and the applications they develop?
That could have a ripple effect on companies like NVIDIA, couldn't it?
Absolutely. It could reshape the entire AI landscape.
Yeah.
And, it just shows how all these seemingly separate threads we're exploring are all interconnected.
Okay, mind blown. I need a minute to process that. But back to Jerry Yang. He also had some really interesting things to say about company culture, right?
Oh, yeah. He's a firm believer in the power of teamwork and creating an environment where people can thrive.
He talks about how Yahoo's early success was rooted in this culture of, you know, trust collaboration, a shared passion for the internet.
And he stresses that it's not just about hiring brilliant minds, it's about creating a space where those minds can come together and do amazing things.
So it's like that saying, teamwork makes the dream work.
Exactly. And he also highlights the importance of listening to users and adapting to their needs. He believes that Yahoo's ability to connect with its audience on a personal level was key to their early growth.
That makes sense. It's about building products that people actually want and need.
Right. And that's a lesson that applies to any company, no matter what industry they're in.
So Jerry Yang's story is full of valuable insights for entrepreneurs and investors alike. He's seen it all, and he's not afraid to share his wisdom.
He's like a walking, talking tech encyclopedia.
Okay, so we've talked a lot about the past and the present, but what about the future? Remember that analyst who predicted a broadening equity market performance in 2025?
Oh, yeah. The idea that investors should look beyond those mega cap tech giants for opportunities.
He specifically mentioned companies like Qualcomm and Cisco as potential winners.
What's interesting is that he sees them benefiting from economic growth and stable inflation, two things that we've been discussing this entire deep dive.
So it's all connected.
Right. And it goes back to the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different sectors and companies to mitigate that risk.
Because, as we've learned, things can change quickly in the market.
That's why it's crucial to stay informed and be adaptable.
Speaking of market indicators, we talked about the KP ratio and how it can help gauge potential bubbles.
Remember, while it's elevated right now, it's nowhere near the levels we saw during the dot-com bubble, but it's still a data point worth watching.
So we should be aware of it, but not freaking out.
Exactly. And that brings us to another interesting topic, real estate investing. Remember that source that argued that it could still be a path to financial independence?
Even with the current challenges.
Right. They emphasized the importance of patience, a well-defined strategy, and focusing on cash flow.
They even suggested that, achieving financial independence within 10 to 15 years is possible.
Yeah.
Using what they call vanilla strategies like buying rental properties.
It's an encouraging message for those seeking alternative ways to build wealth.
But as with any investment, there are always risks involved.
Absolutely. Careful planning, due diligence, and a willingness to adapt to those market changes are essential.
Now let's talk about something a bit different. New York City's congestion pricing plan.
It's a fascinating experiment aimed at reducing traffic and funding those transit improvements.
But will it work? Will people actually change their commuting habits?
Only time will tell. But it raises important questions about urban planning transportation and how we can create more livable cities.
It's a bold move, and it'll be interesting to see what lessons other cities can learn from New York's experience.
Definitely. Now let's circle back to the political landscape and its potential impact on the markets. We talked about how President-elect Trump's policies could influence the U.S. dollar.
That's right. If his trade policies hinder global growth, the dollar could weaken, which could actually benefit companies that export goods.
It's a reminder that political decisions can have those far-reaching economic consequences, and investors need to pay attention to these developments.
It's all part of this interconnected web we've been talking about.
Exactly. And speaking of political shakeups, we can't forget about Michael Barr's resignation from the Federal Reserve.
His departure creates an opportunity for President-elect Trump to appoint a new head of banking supervision.
And this appointment could have a major impact on regulatory decisions and the overall direction of banking oversight.
Some experts believe that Trump's appointee might take a more hands-off approach, which could lead to less oversight and more risk-taking by those financial institutions.
It's a development that could have significant long-term implications for the stability of the financial system.
So much to think about. It's amazing how all these seemingly separate topics are interwoven.
It really highlights the complexity of the world we live in and how everything is connected.
I think we've covered a lot of ground in this part. Ready to wrap things up in part 3.
Absolutely. Let's bring it all together and see what key takeaways we can glean from this deep dive.
Man, what a journey this has been.
Yeah.
We've explored everything from those struggling stocks, the soaring tech giants, political uncertainties, and real-world experiments. Even went back in time a bit with Yahoo's co-founder.
It's been a wild ride for sure, but the real question is, what does it all mean for our listeners? How can they actually, apply these insights to their own lives and decisions?
Yeah, that's the key, right? It's
Yeah.
not just about absorbing all this information. It's about understanding how it connects to our own, goals and aspirations.
Exactly. So let's try to distill some key takeaways from this whole deep dive. What are those big aha moments that people can walk away with?
For me, one of the biggest takeaways is just the importance of staying informed. We saw how these seemingly isolated events like a resignation at the Federal Reserve or a policy decision by the president-elect, they can have these huge ripple effects throughout the entire market and the economy.
It's a powerful reminder that we live in a deeply interconnected world. Understanding those connections is absolutely crucial for making smart decisions, whether you're, managing your investments or just planning for the future.
It's like that butterfly effect thing, right?
Mhm.
One small flap of a butterfly's wings can create a hurricane on the other side of the world.
Exactly. And speaking of interconnectedness, another key takeaway for me is the power of diversification. We saw this play out in both the stock market and in real estate.
Don't put all your eggs in one basket.
Precisely. Spreading your risk across different asset classes, sectors, even geographies can help, protect you from those unexpected downturns and potentially boost your overall returns.
It's not just about money either. Diversification is a good strategy for life in general.
Mm.
Develop a range of skills, build a diverse network, explore different opportunities.
It's about creating a safety net for yourself, both financially and personally.
And that brings me to another big takeaway, the importance of adaptability. The world is changing faster than ever, driven by, technology, geopolitics, evolving social norms.
And as we saw with Jerry Yang's journey, the ones who thrive are the ones who can adapt to those changes.
It's about being comfortable with uncertainty, being open to new possibilities, and always being willing to learn and grow.
It's like surfing. You have to be able to ride those waves, adjust your stance, and go with the flow.
I like that analogy.
Yeah.
So we've talked about staying informed, diversifying, being adaptable. What else stands out to you?
I think it's important to remember the human element in all of this. Technology is a powerful tool, but ultimately it's up to us to decide how it's used.
Yeah, Jerry Yang's comments about the need for ethical considerations in AI development really resonated with me.
It's a timely reminder that we need to be mindful of the potential consequences of our creations.
It's not just about innovation for innovation's sake. It's about using technology to actually benefit society as a whole.
Exactly. And that requires careful thought, open dialogue, a willingness to ask those tough questions.
So as we wrap up this deep dive, I want to leave our listeners with this thought. Knowledge is power, but only if you use it wisely.
Think about how these insights can inform your own decisions, whether you're investing in the market, navigating your career, or just, trying to make sense of this complex world we live in.
We've given you a lot to think about, so take some time to digest it all. Explore these topics further, ask your own questions, and keep diving deep.
Until next time, stay curious and keep exploring.